What's up, traders, and welcome. It's Friday, April 2nd, 2021. I'm Neil Lyons, and this is the big picture, where we'll be taking a closer look at the central themes driving the financial markets in an effort to bring you the most relevant information in a way that makes sense. By the end of today's video, I'm hoping to provide you guys with a much deeper understanding of the central themes at play and what's happening in the financial markets, how that's likely to affect your investing portfolio. So there's a lot to touch on this week. We're going to go over 10-year yields. We're going to go over the dollar. We're going to look at commodities. We're going to talk economic data, all with the end goal to provide you with some actionable insight and, again, a better handle on the most attractive opportunities available to you in the market today. So without further ado, let's jump in. I'll see you on the other side. Before we dive in proper, let's talk about the current major themes at play so we can get a handle on what changes this week imply about the future direction of the stock market. So the main four categories we're going to be looking at as far as macro trends are U.S. equities, the U.S. dollar, 10-year yields, and commodities. These four pieces of macro information are really at the core of the financial markets, and the long-term, mid-term, and near-term trends in these four pieces of information tell us a lot about what's likely to happen next, specifically in the stock market, but also in financial markets broadly, especially when we couple this information with economic data related to growth inflation. We start to have a much bigger 30,000 foot view of the big picture. So this diagram here is going to give you a quick reference as to the long-term, mid-term, and near-term trends. So we're going to keep coming back to this diagram so that we can get a better handle on, not only the trend of these things, but what's happening underneath the hood that's driving the changes in these trends. It's important to remember that the near-term leads to the mid-term, leads to the long-term. So we're going to be looking at things like economic data that's been recently released, performance of various sectors and industries of the market, and various assets in the financial markets to see what specifically is driving the changes in these trends so that we can forecast what's likely to happen next. So first up, we have U.S. equities, the U.S. stock market, right? So that's been up across all time durations. So obviously that's a good thing. Beyond that, we have the U.S. dollar. Now, this for me is where the story really lies. This is where I have the most questions and what I'm watching the closest right now, because the long-term trend in the dollar is down. And there are a ton of reasons as to why that is. Probably the most obvious would be fiscal and monetary stimulus really driving down the price of the dollar. So the long-term trend in the dollar being down. The midterm trend over the last 3 months or so is a little harder to figure out. It's been kind of up and down, consolidating within a range more or less. So let's zoom in a little closer to get a better handle on, this near-term and midterm move. We see that the dollar really found a pretty significant bottom here at the beginning of 2021. After that, we saw some kind of mixed movement. We saw a quick rally and then, another sell-off right there. So it really amounted to just a consolidation for several months until the beginning of March. But in the beginning of March, we saw the dollar really start to pick up and show some strength. It's put in a series of higher highs and higher lows. So we can see, the dollar continuing to edge higher. Now, zooming back out, the dollar's still really weak relative to where it was, even as recently as last year. But this is definitely a strong uptick in the price of the dollar recently. I'm still not convinced that it's a new bullish mid and long-term trend in the dollar. But for now, we're seeing a solid counter trend rally in the dollar. So why does all that matter? Well, the dollar's a pretty big deal. First of all, commodities basically globally are priced in the US dollar. So when the dollar weakens, it requires more dollars to purchase those commodities. So the dollar and commodities share a very strong inverse relationship because of that. So when the dollar's going down, typically commodities go up, or at the very least, they have a really strong reason to go up. And we've really seen that play out over the last year. I'll go ahead and add the commodities, the DBC Broad Commodities ETF to this chart so we can get an idea how they've trended together. And I mean, it becomes immediately apparent how inversely correlated these two assets are. This bright orange line here is DBC, which is a broad commodities ETF, and the candlestick chart here is the dollar. So obviously these things trending in opposite directions most of the time. And as the dollar has weakened over the last year and change, commodities have really taken. So the move in the dollar is pretty important, especially when it relates to commodities. So we'll want to be keeping a really close eye on this near-term uptrend in the dollar to see if that continues and bleeds into the midterm and long term, because that would definitely mark a major inflection point in the market. If the dollar continues higher, we can expect commodities broadly to continue lower. And with commodities having run up so far so fast and the dollar down so hard so fast, this could be an extreme move if it continues. The strength of the dollar also has implications for the stock market. So the S&P 500 in particular, a lot of those companies are multinational. They're international companies that derive a lot of their revenues from overseas. So the degree of demand from foreign importers for US exports is very much sensitive to changes in the price of the dollar. So when the dollar weakens against foreign currencies, it drives demand for US products because they look relatively cheaper to holders of foreign currencies. Now, this relationship isn't quite as strong or as market driving as the relationship between the dollar and commodities, but still, if the dollar continues to weaken, that would be one more tailwind for US equities, for the US stock market. Whereas if the dollar continues to strengthen, as it has here in the near term, that might be one headwind for the stock market. If you get the dollar right, you get a lot of things right. So two important implications about this near-term uptick in the US dollar. As the dollar has strengthened over the last few months, we've seen commodities start to fall off. And that shows up here in our diagram where the long-term and mid-term trends in commodities are both up, but the near-term trend has turned down, which is basically the mere opposite of the dollar. So those two assets really influencing each other right now. I have a feeling that it's the dollar leading commodities because there's just so much going on with fiscal and monetary stimulus. So it's definitely something to keep a closer eye on moving forward. Those things are also driving 10-year yields. Now, what's important to understand about 10-year yields is that they're very sensitive to investors' expectations of inflation. Now, the dollar being down over the long term is inflationary because whenever the dollar is worth less, it requires more dollars to purchase common items. Similarly, commodities being up in the long and mid terms is also inflationary because those are common items that our society relies on to function properly. So as the price of commodities goes up, it becomes more expensive to acquire the things that our society needs to run properly. So a declining dollar and an increase in commodities are both inflationary. And when investors expect more inflation ahead, they're going to demand higher yields on their bond investments so that their profit keeps up with the erosive effects of inflation. So whenever inflation is expected to increase into the future, you can expect 10-year yields to also increase. So to that end, I think of 10-year yields as a proxy for investors' expectations of inflation. Right now, we're seeing 10-year yields up across all time durations, signaling to us that the market thinks that inflation is going to continue to rise. Jumping back into the BaroMATRIX, we have TNX, which is the 10-year US Treasury interest rate index here. You can see that, basically since March 2020, which was the coronavirus lows in the market, the 10-year yield has basically just gone up since then, and it really picked up steam at the beginning of 2021. So we're starting to really see the expectations of inflation take root here in the United States. Again, it's made a series of higher highs and higher lows, and considering what's happening with the US dollar weakening in the long term and commodities strengthening in the long term, we're likely to see a continuation of yields moving higher so long as those long-term trends in the dollar and commodities continues. Again, that's why this near-term transition in the dollar to an uptrend is so important and so influential on the rest of the market, and that's why we really want to be focusing on what's going on with the dollar. So now the big picture is starting to come into view. We have a pretty good handle handle on what's going on with the dollar, commodities, and yields, and how those things are likely to affect the stock market. But before we really dig into the stock market and the various sectors and industries that are likely to outperform based on our analysis of the macro trends, let's also talk about some economic data related to growth and inflation to see what other things might be influencing the major macro trends that we've already taken a look at. So the US economic data coming out recently related to growth has been more or less positive. First up, we have manufacturing PMI. Now, jumping into the BaroMATRIX here on the economic data page, we're looking at PMI composite index here. So this report basically gives us an idea of the manufacturing production levels from month to month. So reading above 50 is positive for the US stock market and signals that as manufacturing production rises, the stock market is likely to benefit from that because of rising corporate profits. So one positive sign for the US economy, for the stock market, the manufacturing related companies in particular. I also wanted to take a look at housing starts because I thought this was kind of interesting. So we'll come back to our drop down here. We'll go up to housing starts. Updates our charts and figures here. We see that on a year-over-year basis, new housing starts has actually declined, showing that demand in the housing market is starting to dry up a little bit. But there's a couple things to consider here. First of all, the most recent data point we have is from February of this year. So that year-over-year rate of change is relative to February of 2020, which COVID-19 hadn't really taken root here in America yet. So we still have a kind of a tough year-over-year comparison there. I'll be interested to see what happens with year-over-year rate of change in housing starts whenever we get March's data, because that'll be comparing to March of 2020 when the US economy really had started to feel the effects of coronavirus. The last piece of data related to growth I wanted to talk about is this total construction spending non-residential. So this is commercial construction spending here in the United States, and it's highly influential on the stock market because there are so many companies involved in construction, especially when we're talking about, the infrastructure, the bare bones of our country. You need steel, you need concrete, so basic materials, you need construction companies, you need architects and city planners. So the more construction spending going on, the bigger a tailwind for the stock market you could expect. And we see that even before coronavirus really came to America, back in, I think this is November of 2019, total construction spending hit a peak and has been in decline ever since then. But we have this new proposed infrastructure plan here in America. Something like $2.25 trillion is the current prospective number. So if and when that goes through and is put into effect, I'd imagine that we'd start to see a real turnaround in this total construction spending non-residential number. That'll be a huge tailwind for the stock market. So as far as growth is concerned, we do have some mixed signals, but the most recent data, PMI manufacturing in particular, was resoundingly positive. And we're coming into a period where the year-over-year base effects, the comparisons to this time last year, are about to get much, much easier. Because now that we're in April, we're going to be looking back to March data, and March 2020 is really when coronavirus took hold and tanked our economy there. So even if the absolute values of some of this economic data aren't remarkable, the year-over-year rates of change are going to start to accelerate and they're going to look great, and that's going to be a huge tailwind for the stock market. So right now, I'm saying that the growth picture here in the economy is more positive than negative and likely to continue getting better in the near and midterms looking forward. That should support a continued move up in the stock market. As for inflation, we've already talked about some of the inflationary pressures at play right now. We have a long-term downtrend in the dollar and commodities also trending up, and all that's been met with an uptrend in the 10-year yield. So we're seeing inflation creeping in and investors' expectations for more inflation ahead. But let's go ahead and take a look at some of the economic data associated with inflation, see if we can further develop our outlook for inflation moving forward. First of all, the headline CPI, or Consumer Price Index figure, has been on the rise. Now, this is one of the main measures of inflation here in the United States. So let's take a closer look and see what's going on here. We'll head to our first drop down where we can select which category of economic data we want to look at. We'll select inflation. And there we go. And then we'll drop down to CPI, Consumer Price Index for all urban customers. So we see that CPI, year over year rate of change, has actually been declining a little bit over the last several months. The reading itself is still positive, currently at about, what is this? 1.28%, but that's happening at a slower pace. So this is disinflation, where inflation is still positive, but at a decreasing rate. Now again, this is looking at the year-over-year rate of change, and the most recent data point that we have here is from February. So once again, that's comparing to February of 2020, which coronavirus and the effects that it had on our economy hadn't really taken root yet here in America. So first of all, once we get March's data, that's gonna be the first data point that really has a favorable base effect, a favorable year-over-year comparison. So that's one thing. The other point I would make is that the CPI reading is a lagging indicator, and economic data in general, for the most part, is lagging, meaning that it looks back into the past to see what has already happened. Whereas price, that's telling us what's happening right now. So we already saw, a weakening dollar and strengthening commodities as far as their prices are concerned, which are much more current and leading indicators. So in this case, those things are leading indicators of inflation. We're seeing commodities on the rise, the dollar in decline. So CPI isn't really reflecting those things yet, but my feeling is that come March, April, May, when we get the CPI figures for those months, we're going to get a significant acceleration in inflation. In my opinion, there's one more thing really keeping inflation at bay right now, and that's capacity utilization. So let's talk about that a little bit. We'll come up here. It's actually not in the inflation category, so let's deselect that. We'll get our economic data drop down here. We'll cruise down to capacity utilization. There you are, total industry. Now, capacity utilization is kind of a hard topic to wrap your head around, but the implications are important for where we're at right now. So cap utilization, it measures the proportion of potential economic output that is actually realized, provides insight into the overall slack in an economy at a given point. Basically, what this is telling us is how much of let's take an example, actually. Let's say there's a manufacturing plant, and typically, if they're running at 100% capacity, they can produce 100,000 widgets in a day, right? But let's say that right now they're only producing 80,000 widgets a day. So they're at 80% utilization, right? Capacity utilization. Because the demand for their widgets isn't there to necessitate them running at 100% capacity. So if demand picks up, they can easily produce more widgets without really making any changes to what they're doing, right? They're already able to produce more than they currently are. So if demand picks up, they're easily able to meet that demand. And until they get to 100% or close to it, they won't need to reinvest in their company to, expand what they're capable of producing. So let's expand that to our entire economy, right? We were just talking about an example of a single company, but let's think of our entire economy and the capacity to which it's capable of running. Right now, with a current value of 73.76 as far as capacity utilization is concerned, it's telling us that we're utilizing about 73, almost 74% of our total capacity here in the United States. So that tells us that there's about 26% more capacity available if demand picks back up. So as demand picks back up, as the world opens back up from the coronavirus lockdowns, and as demand returns, there is capacity available to absorb that demand. So the aggregate of businesses here in the United States is still a long way from needing to reinvest into their businesses in order to meet an increase in demand. Now, looking back over the last year, you can see cap utilization absolutely tanked going back to, March, April, May of 2020, and has steadily been back on the rise since then. So while we're still kind of in slack territory, meaning that there's plenty of excess capacity still available, that trend is narrowing. So my perspective is that so far, this extra slack, this capacity utilization slack here in the economy has absorbed a lot of the inflationary pressures, the decline in the dollar and the increase in commodities specifically. And we still have some room for kind of inflationary absorption here as far as capitalization is concerned. And if I move myself out of the way, we can get a closer look at exactly where that breaking point, that tipping point rather, is. A low capitalization rate, about 0.5 to 0.75, can be concerning. It can lead to deflation. With so much excess capacity, prices may be slow to respond to stimulative efforts by the Federal Reserve. Now, that's what we've been seeing a lot of, is that we had an extremely low capitalization rate over this last year in the face of intense federal stimulative efforts. But the capitalization rate is increasing, meaning that we're running out of slack. So eventually, as that capitalization rate continues to spike, those inflationary pressures are going to become much more apparent and start to be picked up in the headline CPI figure. One last piece of economic data that we'll look at regarding inflation comes back to commodities. So we're going to look at the PPI commodities index, I believe it's called. Let's see. Producer price index for all commodities. That's the one. So we see this is really spiking and obviously accelerating as well. So this goes back to April of 2020. We hit the lows in the economy and for demand for commodities generally at that time. So the year-over-year comparisons will only get more favorable moving forward. But this, to me, that's extremely inflationary and accelerating to the upside. So again, commodities prices, much better leading indicators of an inflationary environment, of inflationary pressures. And that is 100% the case in both commodities prices and the producer price index for all commodities here. So based on all of these things we've just looked at, I think it's fairly apparent that right now, growth and inflation are both positive. So we have a much better framework now by which to take a closer look at the stock market and the various sectors of the stock market. We see the stock market, U.S. equities broadly up over, the long-term, midterm, and near-term. The dollar down over the long-term, consolidating over the midterm, and in a near-term uptrend. So that's where the real questions lie for me. 10-year yields up across all time frames, commodities up in the long and midterm, but a recent near-term downtick. Although looking at today's data, today being April 5th, commodities starting to move back up again. So it's looking more and more like this near-term downtrend in commodities was likely just relief from overbought conditions, more so than an inflection point indicating a new mid and long-term downtrend. But that's still yet to be seen, and that's what I'm keeping a close eye on, is the near-term uptick in the dollar and the near-term downtick in commodities. With all of these things in mind, let's take a closer look at the stock market, at how each of the sectors of the market has performed over the last year and various time frames within the last year to understand what has happened, what's happening now, and to forecast what's likely to happen moving forward. And now that we have our big picture framework to apply all that to, we can develop with much more conviction our outlook for what's likely to happen next. So jumping back to the market watch page of the BaroMATRIX here, we're going to scroll down to the sector rotation infograph. I really like to spend time in here because there's just so much that you can derive about the current state of the market, where the market's been, and where funds are flowing in and out of within the market. So if you're unfamiliar with this infograph, I'll quickly go over. Basically, we're looking at percent change for the various sectors of the market across several different time frames. So the topmost chart gives you the percent change over the last 1 week. Below that, over the last 1 month, 3 months, 6 months, and 12 months at the bottom here. So we're looking at percent change, percent return over various time frames going back in time as you move down the graph. So if we start at the bottom left, we're looking at the 12-month return here. We see that metals and mining has been the biggest gainer, the market leader over the previous 12 months, up over 155% over that time. And in the number 2 and 3 spots, we see materials and energy also up substantially over that time frame. And if we hover over this for a second, we see materials up over 84, almost 85% over the last year, and energy up 82%. So how does that fit into the framework? The big picture that we spent the last 20 or so minutes talking about. Well, we've seen commodities on the rise and we've seen a decline in the dollar. And that's showing up here in our sector rotation study. The metals and mining sector, very sensitive to the price of commodities. Consider a company in the metals and mining sector like Freeport-McMoRan, for example, which is something I've been long for the last 8 months and made a killing in. They're a copper miner, so their profitability is very much dependent on the price, the current market price of copper. So we see metals and mining companies broadly performing really well, as a lot of those companies' profitability is subject to price changes of commodities. Same thing with materials and energy. Sectors of the market very sensitive to changes in the prices of commodities. So as commodities prices have trended up over the last year, these 3 sectors of the stock market in particular have performed well because they've had the tailwind of increased profitability by way of increased prices that they can get for the commodities that they deal in. One more thing to point out as far as the long-term picture here is that we've seen that big decline in the dollar over the last year. And one more implication of a declining dollar is that that's generally a tailwind for the stock market. And once again, that's because a declining dollar makes US assets more attractive for holders of foreign currencies, meaning there's going to be increased demand here in the United States. And that's exactly what we're seeing here, because we're seeing all sectors of the stock market having positive returns over the 12-month time frame, across all time frames actually. So those 2 macro trends, those big picture trends of a declining dollar and increased commodities prices, showing up perfectly here in the long-term view of the stock market by way of our sector rotation studies. So fairly obvious that metals, mining, materials, and energy have outperformed, and the reason as to why that is over the long term. But if I move myself out of the way here, we can see that the 3 worst sectors of the market over the 12-month time frame has been healthcare, staples, and utilities. Now, why is that exactly? While these 3 sectors of the market have a positive return over that time frame, it's to a much lesser degree than most of the other parts of the market. That's because these 3 sectors of the market are typically defensive. These companies, for the most part, deal in products that people need. People always need healthcare. People always need, common day-to-day goods from companies like Walmart, right? So these sectors are considered defensive because their cash flow, their revenue streams are relatively stable. These sectors are not as sensitive to changes in the business cycle. So when times are good and we're in an expansionary phase of the business cycle, other sectors of the market tend to outperform these sectors of the market. Whereas when we're in a contractionary phase of the business cycle and the stock market broadly is down, these 3 sectors tend to outperform the rest of the market because they have fairly reliable cash flow streams. Utilities is a similar story as well, where they have extremely reliable and consistent cash flow streams because people always need power, right? Because of that, utilities companies also tend to have more debt on their balance sheet. You see, when a company needs to raise capital to finance its business operations or to finance growth or new projects, they have 2 options. They can either issue debt or they can issue equity, shares, right? Well, issuing debt is much more profitable for a company. You can make more money financing your operations with debt than you can with equity. And if you want to learn more about why that is, turn to BaroMATRIX University and check out some more of our educational content around just that. So when a company has more reliable, steady cash flow streams, they're able to finance their business operations with an increased ratio of debt to equity. That's called their capital structure. How much debt a company has relative to how much equity a company has. So utilities companies with their steady, reliable cash flow streams and their steady, reliable revenues are able to have a more debt-intensive capital structure, which again allows them to be more profitable. but that also makes them very sensitive to changes in interest rates. Because if interest rates go up, that increased amount of debt that they have on their balance sheet becomes more expensive to service, and that eats away at the utilities company's profitability. So utilities companies are particularly sensitive to changes in interest rates, and we've been seeing that 10-year yield spiking over the last 5 or 6 months especially. So utilities have really underperformed to an even greater degree in the near term, but they've been the market laggard over the long term as well. So now that we have a little bit better of a handle of the long-term view, let's see how things have trended in the near and midterm, and if those trends have started to shift, if funds have started to rotate through the sectors in a way that might change our opinion about the likely future direction of the stock market. I'll move myself back out of the way here. And what's always interesting to note with this sector rotation study is when things move from the bottom left to the upper right, because that's a perfect demonstration of, the flow of funds rotating between sectors. So, again, in the long-term view, we have metals and mining, materials, and energy in the top 3 spots. But if we move to the midterm time frame, the 3-month and 6 months is kind of what I think of as the midterm. We see that financials has crept into the top 3 spots. And why would that be exactly? Well, the financial sector tends to benefit from a rising interest rate environment. And why is that exactly? Well, because banks can be more profitable in higher interest rate environments because they can make a bigger spread between the short-term interest rates that they pay for deposits at their bank versus long-term interest rates that they collect on loans that they're providing. So specifically, banks are more profitable when there's a bigger gap between long-term interest rates and short-term interest rates. Now, that's really described by the yield curve, which indicates what interest rates are at various durations, right? So when the yield curve is steepening, meaning that the long end of the yield curve, longer dated bonds have higher interest rates relative to shorter dated bonds with lower interest rates. The bigger that gap, the more profitable banks tend to be. So generally in a rising interest rate environment, specifically at the long end of the yield curve, 10 years and beyond, you see banks becoming more profitable. And to provide further evidence of that steepening yield curve, let's jump over to the, I'm here in the yield spreads page of the BaroMATRIX. The top tool here is the treasuries. And this top chart is the yield curve. We're looking at the yields of various dated government bonds trending through time. So what we're seeing is that the topmost line, that is the yield on the 30-year US Treasury, whereas the bottommost line is the yield on the 3-month Treasury. So we're seeing the difference between interest rates on US government bonds of varying time frames, and we see that the yields are getting further apart. So again, that's a steepening yield curve and increases banks' profitability. And for even more evidence of that, we see the spread here, the 10-year minus 3-month Treasury yield spread and the 10-year minus 2-year Treasury yield spread there. Now, these two charts literally just take the longer dated yields and subtract the shorter dated yields to give you the difference between those yields, or the spread between those yields, right? So when these two charts go up, that means that the difference is getting bigger. That means that there's a steepening of the yield curve. And that's exactly what we've seen. We're looking back to January 1st, 2020 here. And we see that yield spreads have been up across that time frame, particularly since November or so of 2020. That's really taken off and started to spike for both the 10-year minus 3-month Treasury yield spread and the 10-year minus 2-year. So right there, we're looking at a steepening yield curve, which increases banks' profitability and should provide a tailwind for the financial sector. And that's exactly what we've seen in the sector rotation study. One more implication of a steepening yield curve is that typically indicates that the stock market has been doing well and is likely to continue to do well. And that's exactly what we've seen. The stock market broadly has done really well over the last year and across all time frames within the last year. So looking back to our macro outlook, our big picture outlook, we've seen the 10-year yield up over the last year and really spiking over the last 6 months. So we're seeing that starting to show up in the financial sector here in the midterm, with the 3-month and 6-month return for the financial sector creeping into market leadership territory. So financials typically outperform in rising interest rate environments. And thinking back to our big picture outlook, that's exactly what's happened. Over the last 6 months or so, we've seen spiking 10-year yield, rising interest rates broadly, right? So the financial sector has started to pick up steam and show some market leadership there in the midterm. We also see metals and mining and energy showing back up in the 1 and 2 spots across the midterm. So more evidence that commodities prices have continued to outperform and that these sectors of the market are continuing to be market leaders. Also in the midterm, we see that healthcare, utilities, and staples have all continued to underperform the rest of the market. So the long-term and midterm view pretty clear and very much in line with the big picture outlook of, down dollar, up yields, up commodities. But when we turn our eye to the near term, the 1 week and 1 month returns on the top of the infograph here, things are a little less clear. As far as the 1 month return, we see financials and energy, which had been market leaders over the mid and long term, being the absolute market laggards over the previous month. Conversely, we see real estate and utilities and staples in the 1, 2, and 3 positions as far as the 1 month return. So to me, that's very much a near-term counter trend within a prevailing long and midterm trends, meaning that basically everything just got flipped upside down in the near term. So the question for me becomes, does this near-term counter trend continue and turn into the midterm and long term and start to really dominate the market outlook? Or is this near-term move more of a short-term counter trend, a relief of overbought conditions after the long-term and midterm sectors have performed so well, that maybe they're just taking a quick breather, consolidating, building up energy for another push higher? What I'm seeing right now is that that's more of a relief of overbought conditions in the sectors of the market that have done really well in the long and midterms. Especially considering that when we look to the 1 week returns as the most recent, we see metals and mining resuming its position as the market leader in a pretty substantial way. So for me, that's kind of the first clue that the long-term and midterm trends are likely to resume, but it's coming back in a slightly different way, right? So metals and mining continues to be the market leader, but now in the number 2 position, we have tech. Now, tech's kind of underperformed in the midterm and has been more mixed in the long term, at least over the last 12 months. Tech over the last 3 years has absolutely been the market leader. But we see tech, sort of in the middle over the 12-month time frame, doing worse in the midterm, 6 months, even worse over the last 3 months and 1 month. But recently, it started to make another push higher in a fairly major way. So I'm interested to see if the technology sector is about to make a comeback. And one quick observation that I've had recently about the market is that it's kind of this prevailing market consensus that technology stocks and growth stocks in general can't go up in a rising interest rate environment. And while that does definitely provide a headwind, technology and growth-oriented companies rely on more debt to finance their growth than the typical company might. So, a rising interest rate environment would fundamentally be a headwind, but the history shows that technology stocks and growth stocks absolutely can continue to perform well, even in rising interest rate environments. So I think what's happened is that over the last 6 months, while yields have really taken off and spiked, it's scared investors out of technology and out of growth because they assume that these companies can't do as well in that rising interest rate environment. But I think the fact is that's not as true as the market thinks that it is. So it was kind of an overreaction, and that's why tech has underperformed over the 1 month, 3 months, 6 month timeframes in particular. But I think that we're going to start to see a reversal of that trend, that investors are realizing that technology can do well in a rising interest rate environment. And I think the last 6 months of underperformance in technology is going to turn out to be a midterm consolidation within a prevailing long-term uptrend. So I think we could see a major comeback in technology over the next several months, and it's definitely something to be keeping a closer eye on. Now that's a lot of I thinks and maybes, so that's absolutely just my opinion, my perspective. So rather than hoping for what we think might happen, we'll keep an eye on this every day to see what is happening. But that's certainly one high probability scenario moving forward, and a place where I think there would be a lot of opportunity if that continues the way that I think that it might. So a lot happening with the sector rotation study right now. We could really opine on this endlessly to talk about each of the various sectors, how they've performed over the different time frames, and what's likely to happen next. But I think we got a pretty good handle on the main things happening and the main things to look out for. Definitely a lot shaking and moving in the near term that we need to keep tabs on to understand if any of this near-term counter trend is going to develop into the midterm and long term, and how those things might affect our portfolio allocations, right? So one last thing to think about before we wrap this video up, I want to talk about some quickly factor rotations. Now this works exactly the same way as the sector rotation study above, but instead of looking at sectors of the market, we're looking at segments of the stock market that share similar attributes. So growth versus value, defensive versus cyclical, high beta, low beta, large cap, small cap, to get an understanding of, now that we have a better idea of where we want to be in the market, the sectors we want to be, what types of companies within those sectors would we, are going to be more favorable. Over the long and midterms, we see that high beta, highly volatile stocks have outperformed. And with this recent near-term counter trend, we're seeing more of that, everything upside down bizarro world where high beta was the market leaders of the long and midterm is the market laggard over the 1 month return. And, but again, starting to make its way back to the top in the most recent, the 1 week return. So for me, I'm still focusing my efforts on high beta small cap stocks because those have the long-term and mid-term trends on their sides. But I'm being very much aware of this near-term counter trend move. And if that continues, then we'll be focusing our efforts towards whatever the market leaders as far as style factor rotation is concerned, given changes and new developments in this chart here. So once again, high beta and small cap are my focus, keeping an eye on this near-term counter trend though. So we just spent the last 40 minutes or so crushing out some deep dive research into the macro view, the big picture view of the global financial markets. So let's try to distill all that down into a couple action items that you guys can take away. So what to watch next week. First of all, we saw that this week in the sector rotation study really brought a continuation of the current mid and long-term macro themes where yields continued rising, the dollar continued falling, and commodities continued inflating. After what right now appears to have been a 2 week or so counter trend within a prevailing long-term and mid-term trend. So definitely keeping an eye on the near term to see if the long and midterm trends continue, or if we get more counter trend movement as far as the sector rotation is concerned. The direction of the US dollar is really the $64,000 question right now. It's what I'm looking at the closest. As the near-term strength continues, it could begin a cascade effect influencing the reversal of the current major macro themes. So again, that kind of comes back to the first point where this near-term counter trend move for now looks to have subsided, but I think it'll be very dependent on what happens with the dollar next. If the near-term strength in the dollar continues, we're likely to see metals and mining, commodities in general, continuing to fall out of market leadership. Yields continuing to make higher highs and higher lows. In my opinion, mostly a reaction to continued strength in the commodities space. So that's kind of the narrative right now. Is for me, the genesis is the dollar, right? And more notably, the long-term downtrend in the dollar and the effect that that's had, the cascade effect that that's had on the market. So we have changes in the dollar affecting changes in commodities prices, changes in commodities prices influencing yields and investors' expectations of inflation, and the stock market all reacting to those things. So if inflation starts to really creep in and push yields higher at a faster pace than the Federal Reserve and investors broadly are comfortable with, that could spell warning signs for the stock market. That could be a big headwind. For now, I think we can reasonably expect that inflation is not going to get too out of hand too fast in the very near term. Again, going back to the capacity utilization still being relatively low, so there's more slack where inflation can be absorbed, and there are still plenty of deflationary influences at play. So a big push and pull between these central macro themes at play. But specifically how we want to react to this is be keeping a close eye on the near term to see if the long-term and midterm trends in the big picture themes start to capitulate, and what that might mean for our portfolio and our allocations and which sectors of the market are likely to outperform. Action items specifically for this week, we saw XME, the metals and mining sector, move back into the top position this week as far as market leadership. So I'm of the opinion that that's going to continue, that we're going to see commodities making a comeback in the near term. So I'm still long commodities, specifically, small cap, high beta companies in the metals and mining sector. And that goes back to our factor rotation study. Also, based on the fact that, the economic data we are looking at, especially the most recently released economic data, points to continued growth in the US economy, which would provide a tailwind for companies in the industrials and basic materials sectors in particular, especially if coupled by rising commodities prices, which I also think is likely to continue. So looking very closely at XME, metals and mining, basic materials and industrials. Also financials, I'll be keeping a close eye on 10-year yields, interest rates broadly, to see if the yield spreads continue higher and the yield curve continues to steepen. I would expect financials to regain market leadership, so I'll be keeping a close eye on that sector as well. Still shorting utilities, healthcare, and staples, the defensive stocks, as they still have long-term, mid-term prevailing downtrends. I'm more convinced that the more near-term has been a counter-trend move within those prevailing long mid-term trends. So I'm still expecting a continuation of those things, and we'll continue to short defensive stocks. One last real big opportunity I'm seeing now is a resurgence, a possible comeback of technology, which would be super exciting because I personally have a ton of tech names that I'd be really interested to get back into, given more favorable tailwinds and positive signals for the tech sector, which we're starting to see the beginnings of. So if I see a continuation of that trend in technology with, better performance in the near term, falling volatility in the NASDAQ, which we didn't really talk about today, but falling NASVOL, another positive signal for the technology sector. So I'm looking to leg back into some of these tech names, given a continuation of this near-term strength that we're seeing. That's it for today, guys and gals. Obviously, a lot to think about in the markets, a lot of things moving the markets right now, and intermarket relationships at play. So we'll be once a week taking a look at all of these things and see how things are developing and how that's likely to affect our portfolios, our allocations, and our market outlook going forward. Thanks so much for tuning in. We'll catch you next week on The Big Picture.